Hi folks, this is Hyman, and I want to talk to you about the nature of bubbles, particularly that happen in stock markets. What I've done is I've got a graph here of the NASDAQ, which you'll see heading down here in percentage terms, not in point terms, and pretty much popping from around where the bubble popped in NASDAQ and headed lower. And this may look huge or may not look huge to you, but for instance, right in here is a 60% drop on the index from its high. And of course, it went a lot further than that, probably about 70% or so here, and then closer to 80% here. So it was just an enormous bubble pop that happened. And what I've got up here are emerging market currency pairs. The dollar against the Turkish lira in gray that popped high and first up here. Got the dollar against the Brazilian real right here, and the dollar against the South African rand. And so something I want you to see is, a lot of people think about emerging markets only one way. In other words, they think, well, when economies of the world are growing great and things of that sort, that's a great time to move into emerging market currencies. And that is correct. So when there's global growth, global expansion, unemployment's going down around the world, more jobs are being created, etc. It's a great time to be in emerging markets and in emerging market currencies in particular. So that would be you're being in an emerging market currency and you're short the dollar and you're long the emerging market currency. What I want to talk to you about today is the way a lot of people don't think about emerging market currencies, and that is the flows out of emerging market currencies and back to the dollar. And when does that happen? It happens when stock markets and stock bubbles crash and pop. And the reason why I like that even better, and of course I obviously like being in emerging market currencies when times are good, no doubt about that. But here's why I like this better. When stock bubbles pop, what do stocks do? They fall furiously, and it sets off a panic in markets. And people lose tons of value in a short amount of time. Now, I don't like it that people lose a ton of their wealth in a short amount of time. That's not the part I like. What I like is when these bubbles pop, it creates an enormous opportunity. That's the part that I like. And it creates that opportunity by being long the dollar and short emerging market currencies. And you can pretty much do this across the board, but some will pop better than others. For instance, the dollar against the Turkish lira, in the short term, popped over 100%, as we'll see right here, and quickly went to 120% gain. But even eventually went as high as just over 180% here, and right here, coming close to almost a 200% gain some months later. So the thing is when a bubble pops, one, being long the dollar versus emerging market currencies can be a tremendous trade, but it can also be a very tremendous multi-month trade as well. For instance, you got 1, 2, 3.5 months, and dollar lira produced 180% gain, and it gave back some, but that went on to even go to a greater peak after that, a couple of times more, some months later. While the NASDAQ continued to sell off. And the more dire things got in stocks, and the more the downtrend persisted in stocks, that was fuel to the fire for owning the dollar against emerging market currencies. Emerging market currencies have extreme money flows, but particularly the flows are extreme when it's coming out of emerging markets like their butts set on fire and back into the dollar. And you can make some serious gains during these times. So from time to time, bubbles will emerge in stock markets, and we'll tell you about some of those and how to profit from them, and even the currency pairs in particular that we think may benefit the most from it. But I just wanted to show you a different angle on emerging market currencies than a lot of people are used to. They normally think go into emerging market currencies when times are good, but I also wanted to show you can be long the dollar and short emerging market currencies, or long a dollar pair, or long the dollar against emerging market currencies when times are bad. And that is a surefire way, and sometimes even a quicker way, to make money because the downside panic is always so much more drastic than the upside move. And so that makes the outflows out of emerging markets and back into the buck so much faster, so much quicker, and it just runs these things up so quickly. And you can see that 100%, 180%, 200% gains can be made in certain emerging market currencies over just a handful of months, and it's a tremendous trade. So if you'd like to hear more about our services, feel free to click on the link below this video. Thanks so much for watching. Bye-bye.